wealthy people, the ultra rich people, never sell their assets.
They always borrow.
Elon Musk is sitting on a $3.8 billion loan.
How do you know when your mutual fund is actually underperforming, and when should you actually exit the market? Hello guys, welcome to Clockwise. My name is Providence. You see, we've realized that it's not everyone that will have the patience to undergo the scrutiny or to undergo research or to actually be an analyst in the stock market before they can invest. There are those who just want to just invest. They don't have the time, the patience to analyze the market, to follow the trends, to know the policies, to know how it's been affected, but they just want their money to grow. And that is why we are here today, to actually show you a better way which you can actually invest without actually being a stock market analyst or a financial analyst and still grow your money. Welcome again to Clockwise. Today we'll be discussing mutual funds. Yes, mutual funds. How can you invest in mutual funds and grow your money even without doing the paperwork, even without doing the underground work? What is mutual funds first, and how can it benefit you? And I usually do, I actually am here with my analyst, my stock market analyst, and also a researcher, the one that has a very vast knowledge about the market. You know him already. Now, with a resounding virtual round of applause, please welcome Mr. Ikane. Please welcome to Clockwise again.
Thank you very much for having me once again, and thank you to the audience.
Welcome to Clockwise. The wars are still going on.
Yeah, unfortunately.
Guns everywhere, boots everywhere. And it's affecting the market, actually.
It's affecting.
And it will affect the market even on the long run.
Yeah, except those that have positions in oil. Oil prices are going. I'm very certain that by the time the market opens today, oil prices already in the Asian markets, we have an insane leap, because if Iran, even though OPEC says they would actually increase, they had a meeting yesterday where they decided to increase production or supply. That impact will be there because actually the route through which 20% of the world's oil passed through
was blocked.
It not blocked, but actually there has been an attack on a vessel, and there is a very high chance that as a reprisal attack or as a kind of a revenge for the killing of Khomeini, the Iranian government might want to actually launch attacks on that.
But not just oil price will actually go up. Even military companies that have
military stocks. Defense stocks. That's how we call it. You're talking about Lockheed Martin. You talk about Boeing and some of those other companies that have defense.
It's going to be a very nice time for them.
It's going to be a field day for them.
All right. Now, away from what is happening between Iran, Israel, and United States of America. Today we are discussing mutual funds.
Okay.
You see, most people don't have this patience. It's not everyone that wants to sit down and analyze the markets. Not everyone can actually follow the policies. Not everyone can actually follow the trends for the invest.
Definitely.
There are those who just want to, but they want to invest. How can their money just grow without them being active participants in the day-to-day activities of the market, but they want to see profits? So we are doing this episode for them. So talk to me, as usual, as somebody that wants to invest without having a deep knowledge of the market. What is mutual funds?
Okay, like the word mutual. Mutual means something that involves people. When I say something is mutually beneficial, that means it benefits both parties. So mutual fund is actually a collection. It's like this. Let's say we have about 5 people in this room, and then the 5 of us put funds together and give to me, the manager, to manage the fund, to ensure that I invest in certain assets that will bring returns on investment at the end of a particular year. So the tenure can be different, but most times it's actually denominated on a yearly basis.
Okay, so all mutual funds are denominated on a yearly basis.
In terms of the returns. Okay. So, for example, if we say that the mutual fund returns 17%, for instance, that means 17% for that particular year. Even the fees that you pay also work that way. So the fees that you pay is denominated in terms of a particular year.
Are there different types?
Yes, of course. There are different types of mutual funds, and 3 of them essentially. So, and these 3 are actually designed for different people. Based on your own financial goal, your strategy, and all of that. So, for example, we have the very aggressive one, which is equity fund.
Okay.
So equity fund is a mutual fund that invests in equities, in stocks, in buying companies. So that particular fund is good when you have a long-term horizon.
Okay.
Later on, we'll talk about the strategy.
Yes.
So that's what will really happen, time horizon. So when you have a long-term horizon, then you can look at equity funds. And the reason is simple because, there's a higher volatility. Prices can go up, can go down. For example, like we mentioned earlier on, most companies, because of this geopolitical instability, some stocks will actually go down, some stocks will go up. So for that, you have mutual funds that are focus on equity, and most times these funds you're looking at like 10 years plus. That's the best. 10 years plus, you're almost, in fact, historically speaking, you're almost guaranteed to actually be profitable. But in the short term, because of the volatility, you might not really get anything out, or sometimes you can even be below what you started with. That's number one. The second one is the fixed income fund. So, for example, bonds. So there are some mutual funds that actually invest in bonds.
Okay.
Yeah. So invest in bonds, and that is that one. You can look at a 3-year horizon really, because bonds, the returns are low though, but the risk also low. So for that, it's good for people that are, for instance, someone that is towards retirement. Here is the deal. If you are building a fund for your retirement, it's actually equity that you look at. So for example, let's say you got your first job at the age of 24. Then you are retiring at 60. You have about 36 years. In 36 years, as a matter of fact, if you invest $500 consistently with a 10% annual return on investment, then you can have over $1 million by the time you hit 56. Yes, the numbers are there.
Yeah.
It's because of what we call compounding interest. I've talked about this on this.
And someone said something. So someone said something. Someone said that if you are, let's say for instance in Nigeria, if you invest 20,000 naira monthly with an initial deposit of 100,000 naira, if you invest 20,000 naira monthly, let's say you have a child and you invest 20,000 naira monthly for that child at 17% interest rates in a mutual fund, when that child is up to 30 years, that money will be worth 225 million naira.
Okay, so because we want to be very accurate, so here is how you do it. For starters, I refuse to give a number to the returns that you have. The reason is that even if it is bond, fixed income mutual funds, remember it actually tracks the interest rate, the federal funds rate, or in Nigeria the MPR. So if the CBN and the debt management office, the CBN sets the interest rates.
Okay.
The debt management office the bond market tries to track that. So that's why. But if you look at 17%, for you to be able to find out how this works, if you go to just go online on Google, just do compound interest calculator. When you get the compound interest calculator, it's like an online calculator. Put in the amount of you're starting with. Put in, for example, in terms of return investment or interest, you can put in 17%. There is also a column for monthly addition. If you are going to do monthly addition or you're going to do yearly additions, you put in, and they will ask the time you are starting the additions. So if you put all of that and calculate, it will give you an accurate figure of what it will be in the next 20 years, what you would have contributed personally. Because remember, you are contributing monthly, what you would have contributed personally, as well as what your money has been able to work out based on compounding interest. So it allows you to know
accurate.
As a matter of fact, there's someone, my students, I was teaching them cybersecurity, and then we had a conversation, and I told them, listen, because even though I teach cybersecurity too, so I always like to show my students an opportunity. Cybersecurity is a very lucrative career. So my students, most people that are in tech that suddenly make money are very prone to trying to splurge just to show that they have actually made money. So, but I try to advise my students on how they could invest their money and build a wealth, generational wealth for the future. So I remember I had a few students that said, no, I'm not good. I'm going to take it for myself. My child will come and build his own. But when we crunched the numbers and I showed them what an investment of just 10,000 naira per month could do, I'm talking about some of my students that I'm earning over 200,000 naira. Some of them are earning 100,000. But I tell them, listen, do you know that if you just do 10,000 naira per month consistently for the next 15 years, let's say you have a child now, they saw that child would already become a millionaire, a multimillionaire, as a matter of fact, by the time the child is born. So the child already has a good head start. That's how you build generational wealth. So that's it for
you pay that 10,000 naira on a monthly basis for a particular number of years, like not long.
So let's say, for example, that's why I said you attach this to goals. So for example, I could say I want to invest for my child's education. You can actually create an account specifically for that. I know a lot of people, a lot of my people that I will talk to that actually have that particular portfolio. So they create portfolios for their kids. If I want to have 4 kids, they would actually literally create 4 portfolios for the kids and then invest consistently. So you are looking at your kids. Most of them do practically for university education, because some of them would want their children to get the best tertiary education.
15 years.
So you're looking at no. Nowadays it's 14 years, 15 years.
Okay.
15 years. Most students are already due for the university. So if you do 15 years, and then remember, because of something we are going to discuss later, which is called dollar cost averaging, you are literally doing this automatically. Like you are doing it on a monthly basis. So if you are saying 10,000, that means every month in fact, sometimes you can literally do it to be automatically routed. So automatically 10,000 gets deducted from your account to fund
for 15 years.
For 15 years.
Like how many percent interest?
So that's what I'm saying. I like to give a figure of around 10%.
10%, okay.
Because if inflation cools very seriously, the CBN might want to bring down the monetary MPR. So because of that, I'm looking at something that could be around, let's say inflation comes down to, let's say, maybe around single digits.
10%.
Then you're looking at 10% or so. So if you do that, then you're going to get something very decent. So that's the second type of the second type.
Millionaire before giving birth to that child.
I mean, your child can become a millionaire before he is even born. Think about that. So, and this helps because if something happens, and let's say you are incapacitated, or worst case, you are no more, your children will not suffer because of that. These are the things that people do to ensure that they build a good future for their children, whether or not they are alive. That's one. Sometime maybe in the future, we'll be talking about things around estate planning. So, which is also another part to this. You can actually do an estate planning so that, because in all of this, remember, sometimes there are tax laws, there are tax, responsibilities attached to all of this. So we'll talk about that some other time. But that's the second type. Then the third type of mutual fund is what we call a hybrid. Okay. The hybrid is actually a combination. So you invest in both equities and the fixed income market, bonds. So what happens is that the bonds serve as shock absorber to your portfolio. Equities increase the Sharpe ratio of your portfolio. So so that's how it works. So it balances, because sometimes you could have equity. Remember, mutual funds actually do what? Invest. So they literally track the performance of these equities. So if something happens and there's a market dislocation, then of course equities will go down sharply. But the bonds will actually ensure that the ratio of decline of the portfolio is smoothened out, because of the fact that it's not correlated with the equity market. So you want to bring in pays that are not correlated, and equity as well as fixed income is a good choice. So you have equity fund, you have fixed income, and then you have hybrid. Those are the three types.
I'd like to differentiate between these two. You see, most times people cannot accurately differentiate between ETFs and mutual funds.
Okay.
So what's the basic difference between ETF and mutual funds?
So ETF, like exchange traded funds. These are funds that track the performance of the market.
Okay.
For example, you have the Vanguard S&P 500 broad market index that tracks the performance of the top 500 companies in the US.
Okay.
You have the NGX in Nigeria, tracks the performance of the Nigerian stock market.
Okay.
You have the Dow. You have the NASDAQ, US 100, US Tech 100, tracks the top 100 tech companies in the US. So that's how ETFs work. Then you also have ETFs, even in crypto, like you have the IBIT. IBIT is the largest ETF that is tracking the Bitcoin, the crypto market, by specifically the Bitcoin market.
Okay.
That is by BlackRock. So you have ETFs actually track. ETFs are very specific because they in terms of the fee structure. But before I come to the fee structure, let me talk about the mutual fund. Mutual funds, on the other hand, has someone, a fund manager, invest deliberately in some assets.
Okay, professional manager.
Yeah, professional manager. So literally, you are not picking, when you are doing ETF, you're not picking names, you're not picking winners and losers. And an ETF, for example, if you are doing S&P 500, for example, it tracks the S&P 500. But an ETF mutual fund might do S&P 500, might do the NASDAQ, might do the Dow. So it might expose you to different ETFs. Whereas that is for mutual funds, that ETF fund. But an ETF actually tracks one. Then that's one. Number two. So the second difference is in the fee structure. The fee structure when it comes to to ETFs, you have about some of them charge as low as 5 basis points. But a mutual fund, you'll be looking at something around 150 basis points. That's 1.5%. And that is whether the score management fee. So whether you make money or you don't make money, you pay it.
Okay.
You pay to the manager. So it is one of the things that investors should keep in mind. Whenever you're looking to invest in a mutual fund, the first thing you should look at, apart from, of course, setting out what you want to invest, your time horizon, and all of that, don't underlook the fees. The fees can actually eat into your capital. Okay. Do you know that if you're investing over a 30-year period, a 1.5% fee could cost you thousands, if not tens of thousands of dollars. So you want to be very careful about the fee structure.
Pay attention to the fees.
To the fee structure.
So now, how do I choose the right mutual funds with all these barriers?
So, like I said earlier, there is nothing like a right mutual fund. It depends on your goal. If your goal is for your children's education, okay, for example, if your goal is for retirement, then you are going to be looking at something like equity fund.
Okay.
Equity mutual fund. If you are nearing retirement, you'll be looking at something like fixed income. If you are a guy that is starting out, you could be looking at equity, and you could be looking at equity, or you could be looking at a hybrid. A hybrid, so that you don't have to deal with the shocks. I ask people when they call me and say, which one should I go for? And I tell you, how would you feel if you wake up one morning and you see your portfolio has dipped by 30%? How would you feel? And then, what? I'll lose my mind. That means you are not good with that. So why don't you do a mixture of both? So the equity increases your Sharpe ratio, the bond increases balances, or kind of smooths out or serve as shock absorbers to your equity. So you don't have those sharp drawdowns. But you have to also understand that equities over the long term, it's just historically, over the long term, if you have a long-term horizon, equities will almost always beat fixed income.
Wait, can you actually lose money in a mutual fund? How risky is it?
A mutual fund is risky. Of course, nothing is guaranteed in the market. But mutual fund is risky when it is short-term. It's just it. Historically speaking, when it is short-term, it is risky. Yeah, like I told you, there could be a drawdown. Let's say if there's a black swan event, for instance, Like, I mean, what you have, the geopolitical tension that we're seeing now, if it escalates, it could affect. If you look at Asian stocks this morning, I mean, sharp correction. So because, I mean, these guys have taken out Qatar, UAE, they're like literally like sending missiles to this country. So you expect there to be some shocks in them in those markets. So in a short term, there is a chance of losing money because there could be a correction. And if you unfortunately panic sell when the market is going down, then you are going to lose money. But over the long term, 10 years plus, you are almost guaranteed.
So what is short term?
Short term would be like maybe 1 year.
Short term.
Maybe 1 year to 3 years.
Okay.
Because you know that we have bull and bear markets. And if you are tracking, if you are looking at equity, we've had 2023 was a bull market. This current bull market started in 2023, 2024, 2025, 3 years. 2026, analysts believe it's still going to be a bull market. So we are getting closer to a bear market.
Yeah.
If you are going to look at market cycles. So if that is the case, then that means that if you invest, there's a chance that you could get into a bear market where you could have sometimes up to 20 to 25 to 30% correction in the market. So even if the mutual fund tracks the ETFs, then or equities, then you are most likely going to have a dip on your portfolio.
So investment should be allowed for a long.
So investment, that's what I'm saying. If you're looking at 3 years, it might be you might be underwater. But if you look at a period of let's say 10 years plus, then the chances of being in water is very low because historically speaking, over a 10-year period, you will always be in good shape.
From your experience, do you advise someone to actually invest let's say a lump sum, or maybe you should actually use a systematic investment plan? Should you just invest at once?
That is like trying to time the market. And there is nothing as true as the fact that time in the market will always beat timing the market. Okay. Let me say that one more time. Time in the market will always beat timing the market. That's just the reality. You want to invest using what we call a dollar cost averaging approach. Okay. Meaning you invest a certain amount of money periodically. It smooths out the volatility.
Than investing
lump sum. I mean, you could invest lump sum thinking that that's the bottom. And then you have another 10-20% correction. What happens?
You go back.
So where are you gonna but if you invest, just invest. That's why we talk about making it mechanical. In fact, what I advise newbies, because sometimes, especially if you are starting out, you might be a bit reluctant. So why don't you automate it? Most apps now, most of the trading apps, I mean, we have mentioned a couple of them on this platform. We don't want to reuse them. Most of these apps have a way of automating your investment. So you could let's say you just maybe do 100,000. You want to invest 100,000 lump sum. Why don't you do 100,000 and then ask it to invest? Sometimes weekly, every week, put in 20,000. In 5 weeks, we are done with the 100,000. Yes. So if that happens, you smooth out your entries. And like I said earlier, your profit is actually a function of your entry.
Okay.
Yeah. So if you want to have a smooth entry, then you want to do a dollar cost averaging, or what you call a structured investment plan.
Okay. Now you said something about entering. You see, somebody said something recently. Said that if you don't have an exit plan in the market will give you one.
If you don't, let me put it the way we talk in the market. Say, if you don't take profits, the market will take it for you.
So now, how do you know when your mutual fund is actually underperforming, and when should you actually exit the market?
Okay, so here is the deal. I would say this, and I'm saying this because I've had experience of people that have been burnt, have their fingers burnt because they tried to be smart. Number one, most managers, and this is just the truth, most managers don't outperform the markets. That's what they try to do, but they don't. Number two, and so what that means is, if someone tells you, exit here, don't take it as gospel truth. That's just a reality.
Okay.
So you don't want to, there is no like time that you can say, okay, let me exit the market. In fact, for me, I would tell you that entering the market, like I talked about dollar cost averaging, exiting the market, you could also use dollar cost averaging. But remember, anytime you exit the market or you literally sell, a lot of things happen. If it is a fund that is actively managed, like maybe like an actively managed fund, like either a mutual fund or a hedge fund, remember what happens. The guy comes around to pick his money. The tax man comes around to pick his money. You have triggered a taxable event. So sometimes I advise for people who have a generational wealth mindset, I would say instead of like literally exit, except the strategy has changed, then you want to pull out. Like I said, most mutual funds, they don't invest in one thing. They are diversified, but not too diversified, because when it's too diversified, you will not be able to capture some alphas. Not too diversified, but reasonably diversified, so that the portfolio does not experience some root shock. But if you're looking at a long-term arrangement, so instead of having to sell, I want to exit, come back in, exit, come back in, remote, because what you are literally doing, remember, the guy is charging you 1.5%, whether you like it or not, whether the fund makes money or not. You're already bleeding 1.5% every year. So you selling, you are also going to pay capital gains tax. If it's a dividend stock portfolio, for example, then you are going to pay, I think currently it's about 30%. Or above 30% actually. So you are going to pay taxes on your capital gains. So rather, you could keep on rolling this. Remember, that tax you paid could have been used as a reinvested capital. When we talked about compound interest, when I gave you that example moments ago about compound interest, I assume that you are not taking out of that fund. So what I would say is, adopt the buy, borrow, die strategy. Adopt the buy, borrow, die strategy. And the way it works is, you invest in a mutual fund, you invest in an equity, and then you don't sell what we call an asset, either an income generating asset or a growth asset, an asset that keeps on growing over time, maybe a strong company or a bucket of strong companies that are very resilient, or in the broad market index if you're a starter. Then instead of you selling to fund your lifestyle, or to maybe you want another opportunity shows up that you want to invest in, instead of you selling, why don't you borrow against that? Banks give this facility. There is something we call, even if you are invested in real estate, there's something we call home equity line of credit, HELOC. Home equity line of credit allows you to borrow a certain amount of money using your house, using your property as collateral. And then with this, you can invest. You could fund your lifestyle, whether your children's education. You can also invest in other income generating assets. There is a caveat though, that what you borrow, the interest rate on the amount you borrow, the money you borrow, must be very reasonable. And there's something, banks are very happy to lend to people that have assets, because especially assets that they can easily trade for cash. And because of that, the risk on those that loan is always insanely low. I personally work on a loan facility that I'm paying every year. I'm paying just about 3.52%. I know it will be very in an environment where people are paying 30-something%.
It's very low.
But I pay 3.52%. It's that low, and the reason is simple, because it's backed by equity, by assets. So if I get a loan that I'm paying 3.52%, or call it 4%, and then I buy an asset, even if I decide to invest in the S&P 500, that historically yields about maybe 11 to 15%, though the last 3 years has been very wonderful. But let's say 11 to 15%. Then technically, I have actually enjoyed let's say I took the loan 4%. I invest, and then let's say the fund manager takes 1% from me, or let's say 1.5%. That takes the entire cost factor to 1.5%. If the expense ratio is 1.5%, then you add to the credit fee, which is about 1 or 4%. That takes it to 4.5 or 5.5%. If I'm investing in an asset that gives me even 10%, that means I'm enjoying a 4.5% arbitrage.
Yeah.
So that kind of arbitrage is what we're talking about here. So you continue to borrow against your assets instead of selling. Wealthy people, the ultra rich people, never sell their assets. Elon Musk is sitting on a $3.8 billion loan. Yes. So he doesn't have to sell his equity in Tesla or SpaceX or any of those other companies. He doesn't have to sell it to fund his lifestyle. He doesn't have to sell it to maybe invest in some of his choice projects. No. Rather, he borrows against those assets. So he doesn't have to trigger a tax event. If Elon Musk wants to pay tax, as a matter of fact, there was one recently said that he paid about $10 billion in taxes. Of course, there are still taxes he will pay. But if he were to be selling to fund things and all of that, you can imagine the insane amount he would have to pay. So a good strategy is you buy an income generating asset or a growth asset, you borrow against that asset to fund your lifestyle and to fund your lifestyle as well as to fund other investments. And then when you die, like I said in the last episode, there's what we call a step-up basis. It doesn't apply in Nigeria though, but in other countries, because we are not just speaking to people that want to invest in the Nigerian stock market, we're also speaking to people around the world. So that's why I'm bringing this in. So it's particularly in the US, I know this for sure, there is what we call a step-up basis. That is step up of the cost of the asset. So for example, if you bought something for $10,000, in your lifetime it grows to $1 million. Your heirs take over that asset or inherit that asset at a $10 million valuation. Guess what? I just want to let you know that asset, the cost basis of that asset would automatically revert to $10 million. $10 million. Meaning that if your heirs decide to sell that asset immediately, they're going to pay literally zero capital gains tax. So that is that is the dash part of the strategy. So that's how you build generational wealth. And for me, if you're investing in mutual funds, I don't think you want to invest just for yourself. You want to invest for your children. You want to invest for projects, healthcare, car. If you want to, maybe you want to, in the next 5 years, you want to buy a car. Pulling out funds, it's not the best thing. You could maybe save or invest towards things like a car. So what actually comes to you out of you to buy the car is very little, because your money, given the right time and the right duration, works out the money that you used to buy a car or make other investment types. Yeah.
All right. Now, I know you're an analyst and you're analyzing for some asset management companies. And you just said something at the beginning of this program. You said there's an advice you gave to your students about investments, practical advice. I want to also give those practical advice to my viewers and my subscribers.
Okay.
So exactly what you wanted.
So here is the deal. Don't say, oh, when I earn more, I will invest. There is no set time to invest. You can start as little as possible. I say it, you can...
Even with 10,000 naira.
1,000 naira. To some platforms allows you to invest.
Okay, let's do 10,000 naira.
Wait, okay, 10,000. Listen, 10,000 naira is something that some people... because you afford 10,000 naira, we are talking about when you say invest, remember, we advise, don't invest money that you are going to need very soon. Don't invest money that... you don't invest everything that you have.
Okay, let's say
someone that is earning 50,000 naira.
Okay, let's say 5,000 naira.
Yeah, someone that's earning, okay, let's say some people earn 30,000 naira.
Okay, let's say.
So someone is earning 30,000 naira. You could do like 5,000.
Yeah, let's say 5,000 naira monthly.
So you do 5,000 naira monthly. You invest first, be very consistent about it. Like I said, time in the market will always beat time in the market. So be consistent about it. Ensure that you are very disciplined. You have a long-term horizon, please. The market always goes up and down. Short-term volatility. Long-term, you are almost guaranteed a decent return on investment.
Okay.
So invest consistently, monthly.
Let's say like Stanbic IBTC investment.
Yeah. So let's look at 10%. Then you invest 10%, 5,000 naira monthly for a 10% return on investment, annual return on investment. You don't take out. You do the investment. In 10 years, in 15 years, and sometimes we underestimate what we can achieve in 10 years. 10 years is very far. I tell you, a lot of people, especially a lot of Nigerians, when you tell them, how long do you want this investment to last? They tell you, okay, which 5 years? They will tell you, can I get something I can pull out next year? No. Compound interest time is a very good friend of compound interest. When you allow time to go. Now, here is the deal. You can actually have investments for not daily, but short-term projects. Yes, you could have, but also have investments for long-term
Project.
Goals. Also have that so that you can benefit from compound interest. If you don't give time, you are not going to benefit from compound interest. Albert Einstein said it very well when he said that compound interest is the eighth wonder of the world, and we've seen it a number of times. Look up your compound interest calculator and do the math. When you do that math, you're going to be convinced that you need to start. No matter how little you earn, put away something. Listen, if you cannot invest when you have little, it's not just going to happen automatically when you have much. There is no best time. If you're earning 10,000 naira, okay, don't worry, when I get 100,000 naira, I will invest. Listen, when you get 100,000 naira, what would tend to happen is what we call lifestyle inflation. So you earn 100,000 naira and you don't want to eat at that restaurant you used to eat anymore. You say, I think my level has gone beyond this. Let's say you were hopping from you were using keke. You say, okay, I think I can afford Bolt now. That is lifestyle inflation. There's nothing that hurts investment or wealth generation, wealth building as lifestyle inflation. You have a bump in your salary at your place of work. That bump should reflect in your investment, not on your lifestyle.
Okay.
So you do that consistently with discipline, consistency, and a long-term mindset. You are going to see how this will translate into some very huge gains later. You have a child, or you're about to get married. Think about your children. Your child will get to the university. Your child would need some kind of a head start. Imagine I ask even my clients that come to talk to me. Imagine if you had Donald Trump said, my father gave me a small loan of $1 million. Okay, so imagine if he did not have that $1 million to start with. Imagine some of the rich people. I know some Nigerian billionaires that literally started from zero, but some of them also started with some kind of a head start. They had some kind of a head start. Why wouldn't you give your child? Why wouldn't you love to give your child that kind of a head start? So think about it. If your child could have something to start with at age 15, at age 20, you know that their fortunes would change dramatically. So think about having those kind of investments, and then a lot of things will be simple for you.
20,000 naira monthly for 15 years can make you a multimillionaire.
A multimillionaire, not just you, your children, multimillionaires. And then you also inculcate that discipline in your children. And then you also have an estate structure. Estate structure is, you can actually build up to 100 million. A child will come in and blow it away. So, but what we advise people is have an estate structure wherein there is a third party that actually manages and administers your estate. Yes. So a child doesn't come around. One guy in the bloodline doesn't just show up and blow your sweat away.
All right. That's a very nice one to actually leave it here, and we'll continue the conversation again. You've done well. You've done justice to this conversation on mutual. Because most people don't know what mutual funds is. They only just feel that I have to do research, check in the market, I want to buy the market, and that stuff. You actually sit in your comfort of your home and you watch your money grow. All you just need is patience. Thank you again for coming. And we'll see you again next episode. Now, on that note, we'll draw the curtains of today's episode on Clockwise. And please do not forget to like, subscribe, and put on the notification bell, because if you don't subscribe, you may not see us again. So subscribe and also like. And also do not forget that the elite of 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. My name is Providence. See you again.